Okay, those were some of the top headlines that shaped the day of trade on Monday. Tepid start to the week because while we've seen some recovery from the day's lowest point, we've still not been able to hold on to the 24,250 mark, although 24,200 is something we've held on to. 24,219 to be precise is where we've shut shop. It's been a mild cut of 33 points on the Nifty. So range bound in that sense, but 0.1% lower on the Nifty, 0.2 lower on the Sensex. Nifty Bank took a slightly steeper knock, 0.4% lower on the Nifty Banking Index, because remember, Nifty PSU Banks was the top sectoral loser of the day, one of them. In fact, Defense was the top sectoral loser, followed by Nifty PSU Banks. So that's the kind of cut we're seeing. India VIX was up 3%, and the broader end of the market was quite mixed because at one point, very resilient. That was the kind of move that we were seeing over there. But then you've got the Nifty Midcap that ended absolutely flat, and even worse was the small cap index that was seeing gains of about 0.4% at the start of the session. It has slipped from there. And not only that, in the red, it has closed with cuts of about 0.2%. So that's the kind of cut that we've seen on the broader end of the market too. Sectorally, Nifty Defense was your top losing sector, led lower by Paris Defense, Astra Micro, HAL. These were some of the losers. MTATech, Data Patterns, these were some of the biggest losers on the defense index, followed by PSU Banks, Media, Bank, Finance, and Auto and Nifty Pharma were absolutely flat. On the winning end, however, Nifty Metal did really well on the back of the mining regulations and those rules that came out. Positive for a bunch of companies, and on the back of that, Welspun Corp, in fact, that continued its winning streak from Friday. But SAIL, JSW Steel, Hindalco, Nalco, Jindal Steel, Tata Steel, all of these stocks have seen gains between 1.5% to 3%. This was followed by Realty, Energy, IT, Oil and Gas, and FMCG. FMCG was absolutely flat, but in the green. In terms of the tilt of the Nifty 500, at one point, we were quite even, Steven, but towards the end of the trading day, that shift tilted more towards the declines. You've got 285 stocks in the red and the rest in the green. That's the kind of breadth that we've seen in the broader end. The biggest cuts coming in on BLS International on the back of that Schengen Visa Row, 10.7% cut over there. Balram Purchini on the back of government commentary that prices will continue to remain fixed, 6% lower over there. Aegis Logistics, Schneider, Carborundum were some of the biggest losers. But on the flip side, like we were talking about, the renewal and the extension of the MD CEO term for Vishal Megamart proved to be quite the big positive, 10% uptick over there. IDBI Bank looking very positive as well. A couple of rice stocks, KRBL, LT Foods have done well as rice prices continue to remain elevated. Then you've got your gold financiers, Muthoot, Manappuram that have done well, and Urban Company lastly, 6% gain, because remember on Friday it was a UBS buy initiation, on Monday it was an MK buy initiation. So 2 days in a row the stock has been in focus and has seen some good gains, and that largely sums up the kind of trading day that we've seen on Monday. But shifting focus then, what are going to be some important points, or rather events, to watch out for Tuesday's day of trade? Let's bring on board Sunidhi with that list.
Here are the cues to watch before the upcoming trading sessions. Starting with India, we have the monthly Nifty expiry, so the markets could be a little volatile. Moving on to global markets, in the United States, we have the Conference Board consumer confidence data that will be released, which will give cues on consumer sentiment and the broader economic outlook. Talking about corporate actions and board meetings, we have the Fed Bank Financial Services, which is considering a fundraise. Moving on to IPOs, Shankesh Jewelers and Sunshine Pictures are all set to list, while Augment Enterprises IPO is going to close. Meanwhile, Anno projects will also open for subscription. And finally, moving on to other events, we have China and India, which will hold cross-border talks in Beijing with China's Wang Yi and India's Ajit Doval scheduled to meet.
Well, thank you so much for that, Sunidhi. That's how we're set up. Of course, there is that big announcement which is likely to come in from Scott Bessent as well, which will determine as to what the sanctions on Iran could well be. And those economic sanctions will well drive markets, at least globally as well as here in Asia, tomorrow morning. So we'll try and see as to how that plays out as well. But let me bring on board Rupak Dey, Senior Technical Analyst at LKP Securities. Rupak, great having you. Let's start off with the index call. How are you looking at the market, and how are you looking at the trend on the index at this point in time?
Yeah, hi, Hars. Good to be here. So Nifty, after a positive start, failed towards its 50 EMA on the daily chart as the traders wanted to remain light before any kind of announcement on US sanction on Iran. and possible Iran's response on it. Also, we have our FNO monthly expiry, NSE expiry tomorrow. So traders wanted to have a lower position before tomorrow. So that is why Nifty remained mostly within the range. On the higher end, the resistance was at around 24,350, and on the lower end, support was at 24,200. Though Nifty slipped on an intraday basis below 24,200, but then it closed above 24,200. So as of now, Nifty is a bit safe, but tomorrow if Nifty starts below 24,200, correction might extend. Overall sentiment for Nifty is likely to remain sideways to negative. For Bank Nifty, it is likely to remain sideways. If it falls below 57,500, then correction might remain in the banking space in tomorrow's trading session.
Okay, sideways for the Nifty Bank and sideways to slightly negative is your view for the Nifty. Rupak, hi, good to be speaking with you. Give us a sense of how you're looking at the broader end of the market, because more often than not, when the index is seeing some pressure, at least the broader end is resilient. But today we've seen that reverse for the Nifty small cap index as well. How are you looking at the mid and the small cap baskets?
So I think volatility might spread onto mid and small cap as well. I think the profit booking things might happen in the broader market as well, bearing few stocks. So overall, I think volatility might prevail in tomorrow's trading session, be it Nifty, be it Nifty 500. Profit booking to volatile market trading is likely to remain in tomorrow's trading session. That is what I expect.
Your picks for Tuesday's day of trade, Rupak?
So I think there are some stocks which are going to outperform the overall market. First one would be Jindal Steel. The stock has moved above its recent consolidation, as well as it has reclaimed its 20 days moving average. Sentiment is likely to remain positive around the stock. So it's a buy around 1150 for a target of 1220. A stop loss should be placed below 1117. Another stock which I am liking is HFCL. The stock is moving higher with its higher top higher bottom formation. The momentum is likely to remain in the near term as well. So it's a buy around the current market price for a target of 255. The stop loss should be placed below 228.
Jindal Steel and HFCL have made it to your radar today. Thank you so much for your time today, Rupak, and good to be speaking with you as always. Okay, viewers, with that, time to slip into a very short break. On the other side of the break, watch out for the theme of the day, and that's going to be EMS in focus, along with the cap goods and the performance that we've seen from industrials in the quarter gone by. We are going to be joined by Ms. Renu Baid Pugalia of IIFL Institutional Equities. Very interesting conversation on the other side in terms of the EMS sector, the big boost that we're seeing, who stands to benefit the most, and more importantly, her view on quarter one performance from industrials and cap goods. All this and much more on the other side. Stay tuned.
Welcome back, and you're watching Market Edge, and on today's special coverage we have with us Renu Baid, who's going to join us in just a minute or so. But the government has rolled out a major push for India's electronics manufacturing ecosystem, unveiling mobile phone manufacturing scheme with a total incentive outlay of 62,500 crore rupees, starting FY26 all the way till FY31. Ashesha here with more.
Well, yes, so the entire EMS sector will be in focus today after the government announced the Mobile Phone Manufacturing Scheme, or MPMS. Now, the total incentive outlay will stand at about 62,500 crores over the period of next 5 years from FY26 to FY31. The objective, of course, is to increase mobile phone manufacturing in India, boost exports and increase use of Indian-made components that are used for manufacturing mobile phones. Now, other than that, the scheme also targets large-scale mobile manufacturers players and EMS players, and there are specific targets to be achieved by these companies in order to become eligible for this particular incentive. Large-scale mobile manufacturers need at least 10,000 crores of FY26 revenue to be eligible for this incentive. Companies also need minimum incremental sales every year over a period of 5 years, FY26 to FY31. Now, other than that, the company will get incentive based on additional sales that are generated over this 5-year period. Now, the incentive ranges anywhere between 2.25 to 2.5%, and it will reduce gradually over the 5-year period. Now, Dixon Technologies clearly will be the biggest beneficiary of this scheme that the government has now rolled out. Other than that, Amber Enterprises is likely to be a potential beneficiary given that it has entered into a joint venture agreement for mobile phone manufacturing. Other than that, Sirma SGS, Kaynes Technology and PG Electroplast will be a couple of other players which will benefit as a result of this scheme.
Resha, thanks so much for taking us through that. In fact, today Dixon was surprisingly under pressure, but Reddington did really well on the back of this news flow. The other theme that we're looking to explore in today's discussion is the kind of performance that cap goods companies and industrials have showed in the quarter gone by. T&D and defense, they remain the main key growth drivers, while data centers, AI, renewables and storage also added to the growth opportunity. Private capex is improving is something that we've realized from quarter one earnings, but broad-based recovery is still awaited and exports continue to remain supportive. Coverage inflows grew 3% year-on-year. L&T and KEC International were up 14%, while KPIL fell 23% on a high base. EBB and Siemens have also seen healthy orders from data centers. And this, in a nutshell, is just the kind of performance that we've seen from a bunch of cap goods companies in quarter one. Let's welcome on board Ms. Renu Baid Pugalia, Vice President of Research at IIFL Institutional Equities, joining us. Renu, hi. Good to be speaking with you. First up, weigh in and give us your view on how do you believe the cap goods sector has done. We've seen some pressure coming in on margins, but overall, how sustainable do you think the kind of earnings we've seen are going ahead, and how have you read through the sector in quarter one?
Well, I would say yes, on the earnings side, pressures were inevitable because of the kind of commodity push that we have seen. And part of that is likely to continue in the second quarter as well. But I think the silver lining was clearly from the fact that order inflows were strong. Management commentaries, despite earnings weakness, was fairly bullish. And if we see this pace of order flow finalization picking up, both from government sector orders as well as coming in from the private sector orders that we've seen in from data centers, realty, minerals and metals, that adds a lot of strength to the cycle. And I think that will bring back the optimism for growth coming back in the industrial space through second half of the fiscal 27 and for 28.
Your perspective on this mobile phone manufacturing scheme 2.0, what's the sense like on ground, according to you?
Well, on the mobile manufacturing scheme which government has announced, clearly 2.0 versus 1, one clear difference is there are no low-hanging fruits. The target is to look at higher ASP modules and for large material jump in revenues. So last time the base revenue was fairly small. This time the base revenue requirement is for 10,000 crores, which itself eliminates quite a few mid and small size players or recent entrants in the space. Second, the kind of annualized requirement of growth in revenues is almost 5,000 crores incremental revenues per year. So I think for larger players, especially with export dominance, this scheme is the one to be seen because it gives component level incentives, revenue driven incentives. So for export oriented EMS companies and brands, if I take the headliners, clearly Apple, Samsung, the scheme is designed for them and they should definitely benefit. But clearly other domestic EMS companies like Dixon, which do have some presence on the export front, they cater to brands like Motorola and Smartu. So through them, we definitely see they also benefiting from the export-led push and the scheme the way it has been rolled out.
That's your view on this mobile phone manufacturing scheme. Renu, I just want to come back to cap goods and talk about the kind of commodity pressure, pricing pressure that we've seen. What, in your view, could the pricing pass-through look like, and how quickly could this overhang be behind these companies?
Well, it's not an overhang, it's a reality. Costs continue to rise even today, especially for copper and other commodities. But on the ferrous side, pig iron have already started to soften out. So I think it's a mixed element. Order book driven businesses have already seen price transmission in the recent orders. So all the new orders are come on the current prices. Typically, it takes 2 to 3 quarters for the churn in the order book on mid-cycle and short cycle to happen through. But for large long lead cycle orders, most companies where they thought the pain is a little on the higher side, they've taken provisions and hits in first quarter in their P&L. So in our view, I think as we head towards third quarter, the pain should start to ease out in the numbers and financials. And last year's base becomes favorable also for companies. So margin pressures should start to abate as we come towards the end of the current financial year. And operating leverage and value growth will start kicking across all the companies by that time.
Renu, we've seen some moves within the EMS pack and some very decent moves, right? Stocks have moved upwards. How does risk reward look now, and what are the big buy calls that you have within that pack?
See, I think on the EMS side, growth for core EMS across all companies has been good. Even for players like Dixon, where they were heading against a very weak mobile market, on a sequential basis, they saw growth in volume handsets last quarter. They should be able to broadly sustain those volumes this quarter. Industrial EMS or diversified EMS names like Sirma and Kaynes, both of them saw their core EMS revenues growing in excess of 50%. So I think the growth in the market is there. Where the sector is actually constrained today is supply chain and electronics parts components, which are hitting the companies for real, and everybody's required today to build up inventories and stock it up. So which is putting some near-term pressures on working capital as well. So clearly in terms of clear buys to us, Sirma stands out because of the consistent performance. They have been conservative over the last year and a half, and they have been delivering well on numbers. So that stands out. Dixon, in our view, is now broadly coming out of all their issues and challenges. But yes, the growth will still take a couple of quarters to come through. And the price pressures that they've had on the component side, I think the new JVs on component ecosystem that they have, both from display as well as from memory modules, should start driving or supporting margins towards second half of the year or fourth quarter. And some of the newer initiatives that they're doing beyond mobile phones, specifically on the IT hardware, on the data center servers, they, in my view, would be another large beneficiary of these when we look at 28, 29. So I think Dixon's story will look slightly more elongated versus just the near-term beneficiary of the schemes that we're seeing in terms of announcements. For Kaynes, in our view, the growth levers are intact, but the balance sheet is under stress. So unless we see, in fact, management has mentioned they of some developments to come in the next 1 to 2 quarters on their EMISP player through Istrameco and something more on the OSAT side. So I think any kind of value unlocking, or if they're able to close out the service provider business on the smart metering side, find a new buyer, it will ease out a lot of the working capital stress on their books and bring in the fresh push for the OSAT and the PCB foray where they have been investing time and money. So I think all of these three companies look well to us. Sirma clearly inches up on the valuation front. But in my view, Kaynes could be a good beneficiary if they're able to deliver in the next 6 months. Both absolute alpha in terms of valuations re-rating as well as earnings could be for them. But we need to wait and see how they deliver on their balance sheet front.
Okay, point taken. Renu, last off, curious to know how you're looking at Dixon and this entire Vivo JV of sorts that's evolving, right? Because it's going to be one of the big levers towards that 2 lakh crore revenue, which Saurabh has always spoken about. I wonder how you're looking at delivery on some of those numbers starting FY28, because that's where the real bump up will start to reflect on the full year numbers.
Well, we are not baking in the 2 lakh crore revenue. It's always good for managements to look slightly optimistic. Otherwise, they will not strive or run towards that. But clearly, mobile business now is looking clearly a 1 lakh crore plus revenue stream for them. And if the way business stabilizes, Vivo volume numbers from about 7-8 million units this year, next year should be base case 20 million units. Technically, they can do 25 million units from Vivo alone. So from the base business of 33 million handsets plus Vivo volumes, they should be 50-55 million comfortably. What needs to be seen is with the PLI 2.0, if they are able to extract a higher share of revenues for export market from the key brands, these mobile handset numbers could then inch higher from 55 million to close to 70-75 million over the next 2 years. So I think that is something which will be more closely watched out for Dixon beyond Vivo JV. Vivo JV in our view is broadly there in the price today already. So beyond Vivo JV, how are they able to scale up both on the mobile segment and the other segments, both on telecom and IT hardware, which are higher margin businesses for them. So how that ramps up to deliver a blended margins of 4%. So I think today where we differ from management guidance is our margin expectations are still sub 4%. But if that ramps up, then I think they will deliver both on the ROE as well as the volume growth, which they're targeting and aspiring there.
Right. Renu, last off, what really stood out for me as part of the policy shift, right, which has happened over the weekend is the fact that they want an Indian branded mobile phone manufacturer to make it big. I just have a minute, but very curious to know your view. Realistic?
There is nothing which is unrealistic. Indian brands can do it. They have to make it big. First, they have to think big about it, right? So for a brand to make it big, they need to have both the manufacturing ecosystem and the distribution and reach. So we'll have to see how the Indian brands are able to deliver it. There are a handful of them. Can they really deliver big on the export market, or the big volume ramp up is something which needs to be seen. But I think clearly for the Indian EMS sector, both domestic companies as well as certain foreign companies which operate for global brands, the scheme is a fairly strong scheme for brands to really pull through volumes from India. So I think companies should be able to deliver. ECMS has been a big support in addition to the mobile phone manufacturing scheme which has been announced. So together, hopefully next 5 years, companies will be able to scale up further on the mobile phone manufacturing ecosystem.
Understood. Renu, appreciate your views and appreciate you taking the time out and speaking with us today. Thank you so much. Good to be speaking with you.
Thank you.
Thank you. On that note, viewers, we're completely timed out on this edition of Market Edge. From Harsh, me and the team that put this show together, thanks so much for watching. Keep watching ET Now for more news and updates.